Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial secrets of big companies. And boy do we have some interesting news about Guardant Health today. Get ready to see how they are playing the money game and what it means for their future. This is a pretty important report, an 8K filing with the US Securities and Exchange Commission. Think of it as the company's way of telling us about big sudden changes in their business. It is like a news alert for investors. The main event happened on the 4th of November 2025, which is the date we need to focus on for the big news. So, the core of this filing is about two major financial moves Guardant Health made. First, they entered into an underwriting agreement. Now, what does that mean? Basically, they agreed to sell a lot of their company stock to banks who then turn around and sell it to the public. They plan to sell over 3.8 million shares of their common stock at $90 apiece. This whole deal was about raising a significant chunk of money. After all the fees and costs, they ended up with around $327.2 million from this stock sale. That is a lot of capital to put to work. They're saying this money, along with other funds, will be used for general business stuff. And importantly, they might use some of it to buy back their old convertible notes that are due in 2027. This is a common strategy to manage their debt and improve their financial structure. Then there is the other big piece. They also completed a private offering of convertible senior notes. Convertible notes are a bit of a hybrid, they're like bonds, meaning the company borrows money and promises to pay it back later with interest. But they also have an option for the note holders to convert those notes into shares of the company's stock. This was a huge offering with them borrowing $402.5 million. What is really interesting here is the 0.00% convertible senior notes. This means they're not paying regular interest on these notes. Instead, they promise to pay back the principal amount at maturity, which is in 2033. These notes are unsecured, meaning they aren't backed by specific company assets. They are due in 2033, but can be converted or bought back sooner under certain conditions. They can't just decide to pay back these notes early until late 2029. This gives the note holders some security that they won't be forced to give up their investment too soon. A key detail is what happens if a fundamental change occurs. This could be something like a merger or acquisition. In such a situation, the note holders have the right to get their money back. From this note sale, after costs, they gathered about $390 million. So, when you combine the stock offering and the note offering, Guardant Health has brought in a massive amount of cash in a very short period. This section confirms that these notes were sold without being officially registered with the SEC, which has allowed for sales to qualified institutional buyers under certain conditions. They sold these notes to big institutional investors who are considered sophisticated enough to understand the risks without needing the full public registration process. And when these notes potentially get converted into stock, that conversion itself is expected to be exempt from registration, meaning no extra fees or hoops to jump through for those converting. This part just points to the press releases that accompanied these announcements, letting the world know about the pricing of both the stock and the convertible notes offerings. These are the official announcements they made to the press, essentially confirming all the details we've just discussed. So what is the big picture here for Guardant Health? They've just raised a substantial amount of capital, over $700 million when you combine both offerings. This is a strong signal that the company is looking to grow aggressively, fund future research and development, or perhaps strengthen its balance sheet. The fact that they're not paying regular interest on the convertible notes is a smart move, reducing their immediate cash outflow. However, the 0.00% interest aspect on such a large sum of money due in 2033 is a bit unusual and suggests they are banking on significant future growth or stock appreciation to provide value to the note holders through conversion. The strategy of potentially repurchasing their 2027 notes with this new capital shows they are actively managing their debt obligations. It could mean they believe the 2027 notes are a more costly or less flexible form of financing compared to their current offerings. Looking at the numbers, Guardant Health appears to be confident in its future prospects. Raising this much money suggests they have a clear plan for expansion or development that requires significant investment. The risk, of course, always lies in execution. If they can't deploy this capital effectively to drive growth, the market might question the long-term value of this financing. Competitors in the diagnostic space are also fierce. So guarding their market position will be crucial. The medical diagnostics field is rapidly evolving, and staying ahead means constant innovation and smart financial management. This massive cash infusion gives them the firepower to do just that. Alright, that is our breakdown of Guardant Health's recent financial maneuvers. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.